Hello friends, how are you? Yesterday we have done one question 61, and in 61 number question there was part 2, assuming the company abandons the project if it is worthwhile to do so, compute the new mean NPV, and the value of the abandonment option is rupees 2,50,000. Value of the abandonment option is rupees 2,50,000. So have you tried this? Have you tried this second part that was kept for you? Would you abandon the project at the end of year 1? At the end of year 1, there are 3 possibilities. Either you will get 200 or 300 or 400. If you get 200, then there are only 3 possibilities. You may get 100 or 200 or 300. But if you get 300 in the first year, then you will get 200, 300 or 400. You don't have to write, just wait. Wait for instruction, only understand. If you get 400 in the first year, then you will get 300, 400 or 500. So wait for year 1. Year 1, suppose you get 200, then you will get either this 100 or 200 or 300 only. Then you will not go to other paths. So your expected cash flow of the year 2, after getting 200 in year 1, you will get expected cash flow of year 2 equal to this amount only, because then these are the only path which will open. So we'll compute expected cash flow of year 2 and compute the present value, divide by 1.12 to the power 1. If this figure is greater than 250, that is your abandonment value, we will continue. Else abandon. Similarly, suppose in the year 1 we get 300. From year 0 to year 1, now I know after year 1 is over, which number did I get? There are only 3 possibilities, 100, 200, 300, 400. If I get 300, then the only path which will open up are these 3 paths now. Compute the expected cash flow by multiplying by their probabilities and take the present value. If it is greater than 2,50,000, continue. Else abandon. And the same thing you will do for this also. So if you find your continuation value is more than abandonment value, you will continue. If you find your continuation value is less than abandonment value, then you are going to abandon. Is it right? So let us solve it now. Anybody who have solved it, what is your answer? Under which circumstance we are going to abandon the project? Should we abandon? And if yes, under what circumstance? Have you tried it? So you will write a note. Step 2, evaluation of the proposal to abandon the project. Evaluation of the proposal to abandon the project. Evaluation of the proposal to abandon the project. Write down, if the project is abandoned, at the end of year 1, if the project is abandoned at the end of year 1, the company will realize rupees 2,50,000. The company will realize rupees 2,50,000. However, the company will abandon the project only when the present value of future cash inflows is less than rupees 2,50,000. Present value of future cash flow should be less than rupees 2,50,000. Second note, write down the cash inflow of the second year. Depends on the cash inflow of the first year. Because if first year is 200, the second year would be 100, 200, 300 only. Okay, if first year is 300, then second year cash flow will be only these three possibilities: 200, 300 or 400, like that. Once the cash inflow of the first year is known, we can estimate the likely cash inflow of the second year. We can estimate the likely cash inflow of the second year. Now understand the meaning of this line. If you get 200 in the first year, these are the three cash flows you will get. If you get 300 in the first year, these are the three cash flows you will get. If you get 400 in the first year, these are the three cash flows you will get. Is it right? So now we have to evaluate what will be present value of expected cash flow of the second year if we get 200 in the first year. What will be the present value of cash flow of the second year if we get 300 in the first year, and same thing for 400 also. So therefore we'll have to now write situation 1. Three calculations I will do. Write down situation 1. Assuming cash inflow in year 1 is rupees 200,000 or 2 lakh. Assuming cash inflow in year 1 is 200,000. Assuming cash inflow in year 1 is rupees 200,000. Now write down next line, expected cash inflow of the second year. Expected cash inflow of the second year is equal to, expected cash inflow of the second year will be either 100 or 200 or 300 with these probabilities. 100 into 0.3 plus 200 into 0.5 plus 300 into 0.2. So that comes to 190. Please check and then copy. Is 190 right? 190 will be received in the second year. Abandonment value you will receive at the end of first year. So you need to compute present value. You are in year 1, 190 is in year 2. So you have to discount by 1 year factor. Factor for 1 year is 0.893, already calculated. 190 into 0.893, 169.67. So if you continue after getting 200, if you continue, your present value is 169.67. Present value of the second year cash flow is 169.67. And what is your abandonment value? Your abandonment value is 250. Abandonment value is 250. So what would you prefer, 250 or 169.67? If you abandon, you will get 250. If you continue, you will get 169.67. So the answer is clear. The company should abandon the project. The company should abandon the project if the inflow in the first year is rupees 2 lakh. If the inflow in the first year is rupees 2 lakh. This is one case, because inflow in the first year can be 300 also, 400 also. If I get 200, I will abandon the project, because abandonment value is more than continuation value. Is the answer right? Is it understandable? Yes or no? Or do you have any doubt? Yes. Now write down situation 2. Suppose you start the project, you find that at the end of year 1, cash inflow is 3 lakh. Assuming cash inflow in year 1 is rupees 3 lakh. Assuming cash inflow in year 1 is rupees 3 lakh. Therefore, expected cash inflow of second year. Therefore, expected cash inflow of the second year. Therefore, expected cash inflow of the second year is equal to 200 into 0.3 plus 300 into 0.5 plus 400 into 0.2 plus 400 into 0.2 is equal to 290. Just check 290. And now write down PV of 290. PV of 290 will be 290 into 0.893. PV of 290 is 290 into 0.893, and that is equal to 258.93. Please check. Do not copy. 258.93. And what is my abandonment value? What is my abandonment value? The abandonment value is 250. Abandonment value is 250. What would you prefer? Would you prefer to continue or would you prefer to abandon? Please reply fast. Would you prefer to continue or would you prefer to abandon? The student is saying continue. You are right. Very good. So write down, the company should not abandon the project. The company should not abandon the project if the cash inflow in first year is rupees 3 lakh. So if it is 3 lakh, will continue, because expected value is more. The company should not abandon the project if cash inflow in the first year is rupees 3 lakh. Now same thing we'll try for third case. Suppose you get 400 in the first year. Would you abandon or continue? Write down situation 3. Assuming cash inflow in year 1 is rupees 4 lakh. Assuming cash inflow in year 1 is rupees 4 lakh. Assuming cash inflow in year 1 is rupees 4 lakh. Now write down expected cash inflow of the second year. Expected cash inflow of the second year, 300 into 0.3 plus 400 into 0.4 plus 500 into 0.3 is equal to 400. Please check, is it 400? And then present value of 400 is equal to 400 into 0.893, 400 into 0.893, and that is 357.20. Right, abandonment value. If you abandon at this stage, you will get 250. What would you prefer? Continue or abandon? Quickly reply. Continue or abandon? Continue. Very good. Continue is the right option because you will get more cash flow on continuation. So please write a note. The company should not abandon the project. The company should not abandon the project if cash inflow in the first year is rupees 4 lakh. If cash inflow in the first year is rupees 4 lakh. So the answer is whether the company should abandon the project. The answer is yes if cash inflow in the first year is 2 lakh, but if the cash inflow in the first year is 3 lakh or 4 lakh, then company should not abandon the project. Is it right? So that was a very important question. Answer is still not over. You have to compute the new mean NPV. Suppose you decide to abandon the project in year 1 on getting 200, what will be your revised NPV? What will be your revised NPV? So write down calculation of revised expected NPV. Calculation of revised expected NPV. You can draw this table again. You can draw this table again. First column year 1. Under year 1 write cash flow, discounted cash flow. For discounted cash flow write in bracket 0.893. Again write year 2 cash flow, discounted cash flow. Second year cash flow you will discount using factor 0.797. 0.797. Then total PV of cash flow, cost of the project, NPV, joint probability and expected NPV. Joint probability and expected NPV. Column numbers also write down. Column number 1, 2, 3, 4, 5. 5 is 2 plus 4. 6. 7 equal to 5 minus 6. 8. 9 equal to 7 into 8. 9 is equal to 7 into 8. 9 is equal to 7 into 8. Is it right? If I get 200 in the first year, listen to me, I will abandon the project. I will get 200 from cash flow from operation. 200 is cash flow from operations and 250 I will get from abandonment. So my total cash flow in year 1 would be 450 because I am going to abandon the project at the end of year 1 and I will get 250. So my total cash flow will become 450. Present value multiply by 0.893. 401.85. Because you are going to abandon the project, in year 2 no cash flow. Project is abandoned at the end of year 1 on getting 200. Second year cash flow will not be there. Total is 401.85. Cost of the project 300. Cost of the project 300. So what is the NPV now? NPV is 101.85. NPV is 101.85. My question is now, I want to check, are you intelligent or a copycat? What will be the probability here? Show your intelligence. What will be the probability here? Probability. What is the probability in column number 8? What is the probability that you are going to abandon the project? What is the probability that you are going to abandon the project? Come on, reply. One student has replied 1. 1 is not right. Try again. Try again. The answer is 0.3. The answer is 0.3. Why 0.3? Because I will abandon the project on getting 200. The probability of getting 200 is 0.3. Probability of getting 200 is 0.3. Very simple. Multiply 101.85 into 0.3, 30.56. 30.56. And what about the other cases? In other cases we are going to continue. So what you will do, you will copy from the previous answer part 1. Please copy yourself. This will not change because we are going to continue. Because we are going to continue, this will not change. So you can just copy from your part 1. if you are going to continue, this will not change. So copy and take the total of last column. The total of the last column will change. The total of the last column will change. Is it right? Total of the last column will change. Anybody total of the last column? Please check. This will change. Your NPV will increase. You will find that now your NPV is more. With abandonment option, the NPV goes up. With abandonment option, the NPV goes up. Can you please confirm what is your total of the last column? Can you please confirm what is the total of the last column? Can you please confirm total of the last column? Is it 222.99 approximately? And plus this 30.56 is also there. Yes, it is right. Okay. 222.99 will be the revised mean NPV. Do you confirm it? Would you like to confirm it? Is this higher? Is this higher than the previous NPV? Okay, so this is my answer. We'll go to question number 62. Question number 62, May 2017 exam question. Write down important because it's an exam question. They will repeat again in the next year. Ram Chemical is in production line of chemicals and considering a proposal of building new plant to produce pesticide. The present value of the new proposal is 150 crore. After considering scrap value at the end of the life of the project. Since this is a new product market, survey indicates following variation in PV. Survey indicates following variation in PV. One is if condition is favorable in the first year. If condition is favorable in the first year, PV will increase 30% from its original estimate. So if condition is favorable, the present value will be 195. If condition is sluggish in the first year, PV will decrease by 40% from its original estimate. So PV can be 195 or PV can be 90 depending upon whether the condition is favorable or unfavorable in the first year. In addition, Rama Chemical has an option to abandon the project at the end of year and dispose it for rupees 100 crore. So you have an option to abandon. You have an option to abandon at 100 crore. If the risk-free rate is 8%, then what will be the present value of the put option? This problem we have done in derivative chapter, same question, real option, only figures were different. Derivative, real option, only the figures were different. So I thought one question will take it here also. That will be like a small revision. Option to abandon the project is like holding a put option. If the market price is 195, you will not abandon. You will not exercise the put option. So value of the put option will become 0 because you are not going to exercise the put option. But if the market condition is sluggish, then you can exercise your put option and you can dispose for 100. So value of the put option will become 100 minus 90, that is 10. And then you have to find the value of the put option. So we'll have to apply some knowledge of derivative chapter, some knowledge of this chapter to answer this question. So I would ask you to mark question number 62 as a very important question for the next exam. Write down, in this question we have to find the value of abandonment option. In this question we have to find the value of the abandonment option, that is put option. In this question we have to find the value of the abandonment option, that is put option, and then write down the details. It is like solving a problem of binomial model or risk neutral model. It is like binomial or risk neutral model. I hope you remember risk neutral model. Okay, write down, spot price is 150, spot price is 150, exercise price is 100 rupees, exercise price is 100 rupees, time is 1 year, time is 1 year, rate of interest is equal to 8%, rate of interest is equal to 8%, rate of interest is equal to 8%. So don't you think it looks like a problem of derivative option? Write down step 1, decision tree showing payoff, decision tree showing payoff, decision tree showing payoff, spot price is 150, year 0. Then there are two possibilities. If the market is favorable, it will rise to 195. If the market is sluggish, it will go down to 90. So either you can get 190 or you can get 90. If it is 195, payoff of the put option will be 0. Sir, why 0? Because in case of put option, as we have studied, it is exercisable only when the market price is below the exercise price. Why would you abandon at 100 rupees when you can get 195? Simple. So put option would lapse. Put will not be exercised. Whereas if suppose the market is sluggish, you will get 90. Whereas you can abandon at 100. You can abandon at 100. So I would prefer to abandon and get 100 instead of 90. So the value of put option will be 10. Value of the put option will be 10. Value of the put option will be 10. Now I will need to find out the probability that the value will go to 195 or the value can go down to 90. After computing probability, we will compute expected value of the put option at the end of year 1. After computing expected value of put option, we will compute present value of the put option, and that will be the answer for this question. Do you remember the formula for probability? Anybody? Formula for probability. Formula for probability. For computing probability under risk neutral model. Let us see who will reply. Yes, come on. Scratch your brain and see your memory permits you to recall the formula for probability. So don't worry if you don't remember. Write down a note. Write down a note below the graph. We shall calculate probability we shall calculate the probability of favorable condition. We shall calculate the probability of favorable condition in bracket P using risk neutral model. Using risk neutral model as follows. Using risk neutral model as follows. Then write down step 1. Step 1, or you can say step 2 if you want. Calculation of probability of favorable condition assuming interest is compounded annually. Assuming interest is compounded annually, because if you refer the institute answer, they have assumed annual compounding. Can we assume continuous compounding? Your question is yes, you can use continuous compounding also, but better to keep things simple. P is equal to R minus D upon U minus D. What is the value of R? R means spot price multiplied by interest factor for 1 year. Interest rate is 8%. If 150 is invested for 1 year, how much will you get? 150 into 1.08. D means the lower value, downward value, 90. U means the higher value, 195 minus downward value 90. Now I will not tell you the probability, you have to compute and tell me, because you are not replying. So I want to check whether you are awake or not. What is the probability? What is the probability? First you multiply this to minus 90 divided by 195 minus 90. Divya has replied 0.686. Very good. Anup has also replied 0.6857. Both are okay. You can write in 3 or 4 digits. So 1 minus P will be equal to 1 minus P will be equal to 1 minus 0.686. Very good. 0.314. Once you have got the probabilities, you can multiply by the values and you will get expected value of put option on expiry, that is after 1 year. So write down below step 3, expected payoff at year 1. Expected payoff at year 1 is equal to P into 0 plus 1 minus P into 10. Or you can directly write this line 0.686 into 0, because if the market is favorable, value of put option is 0. If market is sluggish, the value of put option is 10. Multiply by the probability. Why we have not taken PV of 100 crore? We have to find the value of put option using this binomial model or risk neutral model. Therefore, we have considered that 100 indirectly in this calculation. We have to first see what is the value of put option on expiry. So put can either assume 0 value or 10. This 10 has taken into account 100 minus 90. So this is how derivative option model will work. First you will have to check what is the value of option on expiry and then compute the present value. Okay. So write down the answer. The value of the put option is rupees 3.14 crore. Similar thing we have done in risk neutral model also. We need to find expected value on expiry of the put option, then compute the present value. Okay, so this answer is over 3.14 crore. No, not over. One more step. Step number 4, write down. This is on expiry. Step 4 will be PV of expected payoff. So here we are indirectly considering 100 in the calculation by computing expected value of put on expiry. So you will get 3.14 on expiry. Present value will be divided by 1.08. Divided by 1.08. So please confirm the answer. Is it 2.907 crore? Is it 2.907 crore? Is it 2.907 crore? Yes. So this is called value of put option. By holding the put option, that is option to abandon, you can prevent the losses. If the market is sluggish, you can exercise the put option and you can prevent the losses. If the market is favorable, let the put option lapse and you will enjoy the gain. So write a note, the value of abandonment option, that is put option, is rupees 2.907 crore. Is 2.907 crore. The value of abandonment option or put option is rupees 2.907 crore. Okay. This was, I have taken 3 questions on abandonment. One question we have also taken in chapter of derivative real options. In fact, this question was very similar to the question we have taken on the topic derivative real options. Now the next option is option to expand. The nature of the project may be such that in future you may like to expand it. If the business becomes successful, then you may like to expand it. So you have to find out whether we need to expand, whether we should exercise the option of expansion, and what is the value of expansion option. So I have found one question on this option to expand. It is not from the study material. Write down the source reference book. Your study material does not have any question on option to expand, but they will ask in the exam. Question is, a project with an initial cost of rupees 2,50,000 provides an annual CFAT of rupees 42,500 for 15 years. So this is my original information. Life 15 year, CFAT 42,500, cost 2,50,000 if the project proves favorable. Chances of which are 50%. It will become favorable with 50% probability. An expansion at a cost of rupees 5 lakh could be taken up at the end of the 4th year. So if the project is favorable, whose probability is 50%, we are going to expand the project by investing another 50 lakh. We will expand by investing another 5 lakh, not 50, 5 lakh. And what is incremental CFAT? Underline the word incremental. Incremental means because of this 5 lakh investment, your cash flow will increase by 70 to 500 from year 5 to 15. So 5 lakh you will incur in year 4, and from 5 to 15 you will enjoy an incremental cash flow of 70 to 500. Advice, cost of capital is 8%, that is for discounting. Advice, will you invest in initial project? This is my initial project and this is the answer. Very basic question of capital budgeting. First part is very easy, you must do it. Second part, what is the worth of the project with the option? Is it acceptable? What is the value of the option? Now in this question, we have to check how much NPV we will get if we expand the project, whose probability is 50%. How much NPV we will get if we expand the project? Value of the project with the option will be value of the project without option plus the value of the option. The question is it acceptable? If my NPV increases with expansion option, if NPV is more with expansion option, then it is acceptable. Otherwise, it is not acceptable. And what is the value of the option? Value of the option is the difference between NPV with expansion option minus NPV without expansion option. Is it right? So first you write down answer of part 1. At least 2 marks you will get easily. Calculation of NPV of initial project, like a school level question solve. NPV of initial project. Format is same. Year, particular, cash flow, PV factor at 8% and PV. Please solve on your own. Don't wait for copying. Year 0, cost of the project. Year 0, cost of the project 2,50,000. PV factor is 1, 2,50,000. Year 1 to 15, year 1 to 15, CF80 42,500. 42,500. Now check the present value factor at 8% and 15 year. Please check PV factor at 8% and 15 year. 8.559. 8.559. Please check. Or you have your book. Those who have the class notes, at the end of the book we have given all annuity table. So 8.559 is right. Multiply. You will get 363,779. Please take the total. The total is 113,779. 113,779. 113,779 is the NPV of the initial project without expansion option. NPV of the initial project without the expansion option. Now write down step 2, calculation of NPV of the expansion option. Calculation of NPV of the expansion option. NPV of the expansion option, there are 2 possibilities. The project may be successful, project may be unsuccessful. If the project is successful, then we will expand it. And if the project is unsuccessful, we will not expand it. So unsuccessful will have 0 NPV, but successful will have some positive NPV. So let us calculate NPV of expansion decision. Under that we have 2 possibilities: success, failure. If success, this is what your cash flow would be. Write down the format first. A new question for you, not in the study material. Year, particular, cash flow, discounting factor at 8% and discounted cash flow. DCF means discounted cash flow. When will you incur the expansion cost? At the end of year 4. So year 4 write down cost of expansion. Be careful, don't write 0. And you will incur 5 lakh. Calculate the factor at 8% for 4 year. 4th year. 4th year factor. Yes, come on, 4th year factor. 0.7350. And my total is 367,500. Then year 5 to 15. Year 5-15. Year 5-15. Incremental CF80, which is given in the problem 72,500. Incremental means over and above 42,500. Some student want to deduct 42,500. You will not do that. You will not do that. Discounting factor at 8%, 5.2474. 5.2474, 380,437, 380,437, 380,437, multiply 72,500 into 5.2474. Are you able to calculate this factor? If yes, then tell me. If no, then I will explain. Are you able to calculate the factor? Yes. Multiply, take total. 12,937. 12,937. But you will get 12,937 whose probability is only 0.5, because success has a probability of 0.5. So I will compute expected value. Success has a probability of 0.5, failure has a probability of 0.5. If it is failure, you will not expand, NPV 0. If it is success, you will expand, NPV is 12,937. So my expected NPV, write down. Next line, note. Some student stop here, which will be wrong, because you will get 12,937 with 0.5 probability only. And we have to decide today. We have to take decision today. I don't know what will happen after 4 years. So I need to compute expected value. As the chances of project proving favorable is 0.5, as the chances of project proving favorable is 0.5, expected NPV is equal to, expected NPV is equal to 12,937 into 0.5, 12,937 into 0.5, 12,937 into 0.5, 6469. Write down 6469, 6469. Next line, write down. Next line, NPV of the project with expansion option. So with expansion option, the NPV of the project will increase by 6469. So please write down NPV of the project with expansion option. With expansion option, NPV will increase. 1,13,779 was your NPV for the initial project. If you have option to expand also, that will enhance the NPV by 6469. So total will be 120,248. 120,248. Now question is, what is the value of the option? Value of the option is NPV with expansion option, NPV with expansion option minus NPV without expansion option. NPV with expansion option minus NPV without expansion option. Therefore, the answer will be 120,248 minus 113,779 minus 113,779. Answer comes to 6469. Please check. Is it right? 6469. And then the question is whether the project with expansion option is acceptable. The answer is yes. The answer is yes, because your NPV will go up. So write down the conclusion. The expansion option is acceptable. The expansion option is acceptable because the NPV with expansion option, because the NPV with expansion option is more than NPV without expansion option. NPV with expansion option is more than NPV without expansion option. This was a wonderful question we have solved. So we have covered option to abandon, option to expand, and now my third option is option to replace. Option to replace. Whether we should continue with the old asset or whether we should purchase a new asset and replace the old asset. Because as an asset becomes older, what happens? Its efficiency can go down. It will require more maintenance expense. It will require more repair expense. It may break down. It may break down. And if it breaks down, again you have to incur expenses. You have committed some delivery schedule to the customer, and if your machine breaks down, then you will not be able to deliver to the customer on time, and the customer may suffer, which means your goodwill can be affected. So the question that they ask you usually, which you have probably studied in the intermediate syllabus also, that whether the old machine should be replaced by the new machine or not. So that is a usual question, and there are varieties of questions you can get here. We are going to solve some of them, and that will give you an idea how to solve question on replacement. But here we get two types of questions. One, whether to replace the old asset by the new one. But the second question, second type of question, which you have probably not done in detail in intermediate, is optimum replacement timing. Optimum replacement timing means when should you replace an old asset? When should you replace an old asset? For example, this is a machine. This machine can last for 10 years. This machine can last for 10 years. But if you continue to use up to the end of 10 years, then probably you will find that your salvage value has gone down drastically. Repairs and maintenance cost has increased significantly. The output has also reduced significantly. So you can replace it in year 3 also, 4 also, 5 also, 6 also, 7, 8, 9. Company will require the same machine. Company would require the same machine. But the question is, should I necessarily go up to the year 10, or is it more advantageous that we can replace it somewhere in between and get more benefit out of it? So you have to decide your replacement cycle. Take your mobile phone. Okay, you have a mobile phone, you can actually use it for 10 years. You can actually use it for 10 years. Do you actually use it for 10 years? No. You have decided a replacement cycle. After every 2 years, I'll purchase a new mobile phone. Of course, in your case, you have not done the detailed financial calculation, but companies have to do it. Let's say Zomato company has got vehicles for delivery boy. Okay, they give vehicles to delivery boy. That vehicle can last for 20 years. Is it right? But are they going to use it for 20 years? No, they will decide a replacement cycle that after every 4 years I'll replace, because as the vehicle will become older, then there can be repairs, maintenance, breakdown, and your promise to deliver in 30 minutes will not be fulfilled. Then the customer will write a bad review about you. Customer will not place order on your app. So therefore they have to keep on replacing the vehicle so that the efficiency is maintained. So they will find out what is the optimum replacement cycle which gives them maximum benefit, and that is called optimum replacement timing. That is another type of question which will require another set of skills to identify optimum replacement cycle. But today, first few minutes, we are going to discuss about replacement of an old asset by a new asset. Is it right? And the decision will be taken purely on financial ground. That means if my numbers permit me to replace, I'll replace. If my numbers don't permit, I will not replace. No emotional attachment with the old asset, okay, or no fancy for the new asset. You have to answer on the basis of numbers. So what do? There are two approaches. There are two approaches. One is called total approach and one is called incremental approach. One is called total approach, one is called incremental approach. Sir, what is total approach? Total approach means treat the two assets as two mutually exclusive proposal. Treat the two assets as two mutually exclusive proposal. What does that mean? You treat as if you have to make a choice between the old asset and the new asset. You have to make a choice between the old and the new asset. If you continue with the old asset, what will be cash flow in year 0? Year 1, 2, 3, 4, 5, salvage value. If you purchase a new machine, what will be your cash flow in the year 0, 1, 2, 3, 4, 5 and salvage value. Just like in intermediate, we used to solve basic question. Should you buy machine A or machine B? Should you invest in project A or project B? And each project is evaluated independently and the decision making is simple. Like you are making a choice between two mutually exclusive proposals. If NPV of purchase option, that is replacement by a new asset, is greater than NPV of the continuing option, if by purchasing a new machine it gives me more NPV, I will purchase the new machine. If purchasing new machine gives me lower NPV, then continuing with the old asset, I will continue with the old asset. And if the NPV of the purchase option is equal to NPV of the continuing option, both are equal. So theoretically, you will say indifference, because my NPV is equal under the continuation of the old asset and the purchase of the new asset, I'll be indifferent. Okay, total approach. But the problem of using total approach is you should be given enough data. You should be given data in such a manner that you would be able to compute separately the NPV of the old asset and the NPV of the new asset, which means you should be given today what is the opportunity value of that new asset, what will be the working capital requirement of the new old asset today, what will be sales, variable cost, fixed cost, running cost, maintenance cost, salvage of old assets separately and new assets separately. Then you can apply this approach. Many times data is given to the student is not sufficient for applying total approach. Then we can apply incremental approach. Sir, what is incremental? Incremental means from year 0 till the last year n, how much will be my incremental inflow or outflow if I replace the old asset by the new one? How much is my incremental inflow or outflow if I replace the old asset by the new one? So it is like in total approach, this is cash flow of the old, this is cash flow of the new. In incremental approach, it is the difference in the two cash flow. Okay, so theoretically speaking, the answer will be same under both the approaches, total and incremental, because in total approach I am writing suppose 100 here and 150 here. In incremental approach I am going to write 50. If I am going to write salvage value 20,000 here, 25,000 here, in incremental approach I am going to write 5,000 incremental salvage value. If I am going to write CF80 2 lakh here, CF80 3 lakh here, incremental approach I am going to write 1 lakh incremental CF80. Is it right? So you have to calculate at each year, for each year, what is my incremental cash flow. For example, in year 0, what will be my incremental cash flow? Cost of the new asset, working capital of the new asset. But if I am going to replace the old asset by the new asset, then I will get net salvage value of the old asset. So this is my investment 2 lakh rupees. Working capital required suppose 50,000. Old asset can be sold for 60,000. Net of expense, net of tax, and with working capital of old asset will be recovered, say 30,000. So effectively, what is my net cash outflow or incremental cash outflow in the year 0? It is the difference between how much money you would invest in the new asset minus how much money you will recover from the old asset. So that is my net investment or incremental investment. Then during the life of the project, suppose the life of the project is 5 years, we will compare what cash flow after tax new asset will generate minus what cash flow after tax old asset will generate or would have generated. So that means how much incremental CFAT I will generate if I replace the old asset with the new one. And the same thing you will do in the last year also. In the last year, terminal year, we will compute two things again. Incremental salvage value. Incremental salvage value means how much additional salvage value I will get. How much additional salvage value I will get if I replace the old asset with the new one. The new asset would have given me 10,000 rupees salvage value. Old would have given me 5,000 rupees. So I will get 5,000 rupees incremental salvage value. Same thing, if I would have continued with the old asset, I would have recovered 30,000 working capital. With the new asset, I am going to recover 50,000 working capital. So my incremental recovery of working capital will be 20,000. In short, I'll tell you, in every year from 0 to n, what will you get from new asset versus what you would have got in the old asset? That difference is incremental CFAT. Now we'll take decision. Then you compute NPV. That is called incremental NPV. After computing incremental NPV, now what is the decision making rule? The answer is, if the incremental NPV is positive, if the incremental NPV is positive, it means the new asset generates more NPV than what old asset would have generated. So replace the old asset with the new one. If incremental NPV is negative, what does that mean? It means the new asset generates less NPV than what old asset would have generated. So I will retain the old asset. I will not replace the old asset. And the last one, theoretically, if suppose your NPV is 0, 0 means both old and new are offering me same NPV, I will say indifference. I can either continue or I can purchase the new asset, indifference. So far in none of the question incremental NPV equal to 0 we have computed or got it. So don't worry, I don't think in any question you will get the NPV equal to 0. There is a second type of situation here which is practically more feasible. The remaining life of old asset is say 5 years. Remaining life of the old asset is 5 years. Life of new asset is 10 years. If I compute the NPV, they are not comparable. If I compute NPV here, 5 years. If I compute NPV here, I'll take 10 years. These are not comparable. These are not comparable. I can't apply incremental approach also. I can't apply total approach also because they are not comparable. How would you compare a 5-year life asset with 10-year life asset? They are not comparable. 10-year will always win. It will generate cash flow for 10 years. So then you will be biased towards replacement. So here we have a trick. We are going to compare EAC or EAB. EAC or EAB technique is used when we are comparing options with different lives. Is it right? And how do we compute it? The formula is NPV divided by PV annuity factor. Your question is, what is EAC? EAC means equivalent annualized cost. What is EAB? Equivalent annualized benefit. So if my objective is cost minimization, then I will compute EAC. If my objective is benefit maximization, I will compute EAB. And then how do I take a decision? I take a decision based on what is my objective. If my objective is cost minimization, if old asset has a lower EAC, I will go with old asset continue. If my objective is benefit maximization, then I will choose the option which has higher EAB, that is where benefit per annum is more, and that way we will take a decision when we are comparing old asset and new asset, where the life of the old asset and the new asset are different. Is it right? Honestly tell me, have you studied equivalent annualized cost benefit method in your capital budgeting chapter? Just honestly tell me yes or no. I will not judge you. Have you studied EAC or EAB method in the intermediate capital budgeting chapter? Okay, some of you are not able to remember. Otherwise, typing yes was not a very difficult task. Irrespective of what you have done, now forget it. Start fresh. Learn new thing now. Okay. So equivalent annualized cost benefit method will be required only when comparison is with project or asset with different lives. Otherwise, usually we don't come to this method. NPV method serves the purpose. So I have made a small summary for you. It is printed in the book also. Decision will be taken in under EAC method. In benefit maximization problem, select the option with higher EAB. In cost minimization problem, select the option with lower EAC. Is it right? Everything is printed in your book. You have to today revise it, and then you will really enjoy this chapter. Chapter is very interesting, and we have large varieties of question here. We can take 100 more questions and the chapter can continue. So I will take some of the very important questions asked in different exams of the institute. Okay, question number 64. In bracket old exam question, because this chapter was there since beginning of the institute formation, and replacement questions were always there. AS Foundation is considering a proposal to replace one of its machines. One of its machines, underline. There are many machines. We are considering replacement of one of the machines. In this connection, the following information is available. Existing machine was bought 3 years ago for rupees 10 lakh. Now tell me quickly, why don't you respond? I don't understand. When I asked, have you studied EAC or EAB method, nobody responded. Now reply fast. Whether this 10 lakh rupees incurred 3 years ago, is it relevant or irrelevant? Relevant or irrelevant? Whether 10 lakh historical cost is relevant or irrelevant? The answer is irrelevant. Irrelevant. Unnecessary, given to confuse you and extract money from you. Okay, you are poor students and they want to extract more money from you. It was depreciated at 25% per annum on reducing balance basis. What is reducing balance? WDV. WDV method. 3 years are already over. Okay, 3 years are over and it has a remaining life of 5 years. It has a remaining life of 5 years. Old machine can be used for 5 more years, but its maintenance cost will be rupees 50,000 per annum from the 6th year of its installation. Now, what is the interpretation of this line? It was installed here. 3 years are already over. 3 years are already over. Maintenance cost will be 50,000 from 6th year of the installation. This is 4th year. This is 5th year. So maintenance cost will start from 6th year of installation. But we are standing here. We are standing here. So maintenance cost from today, if I count, it will start from 3rd year from today. Next 2 year, no maintenance, but maintenance will start from 3rd year, 4th year, 5th year. So last 3 year of the old machine, in the last 3 year of the old machine, we are going to incur 50,000 maintenance cost if we continue with the old asset. If we continue with the old asset, we'll get 50k, 50k, 50k. But if we sell it, we will save it. If we sell it, we will save it. Its present realizable value is 6 lakh. Today it can be sold for 6 lakh. Is 6 lakh relevant or irrelevant? Is 6 lakh relevant or irrelevant? Today it can be sold for 6 lakh is relevant. You are right. It is relevant. So first I'll erase it. Up to this you have understood the new machine will cost rupees 15 lakh. Is it relevant? 15 lakh cost of new machine. Relevant or irrelevant? Relevant. Very good. Then and is subject to same rate of depreciation. Subject to same rate of depreciation means 25%. So can we say it belongs to same block of asset? The new machine belongs to same block of asset. I think in income tax you are taught asset having same depreciation rate belongs to same block of asset. It belongs to same block of asset. On sale after 5 years, it is expected to net rupees 9 lakh. The new machine will give you 9 lakh salvage value after 5 years. With the new machine, operating cost other than depreciation are expected to decrease by 1 lakh. So benefit number 1, benefit number 1 is operating cost will reduce. Benefit number 2, old machine maintenance cost will not be required. If you are going to sell the old machine and buy the new machine, maintenance cost of the old asset will not be required. And one more benefit, in addition, the speed of the new machine would increase productivity, on account of which net revenue would increase by 1.5 lakh per annum. Benefit number 3. First benefit, operating cost will reduce. Second benefit, maintenance cost of old machine will not be required, hence saved. Third benefit, the operating revenue will increase by 1.5 lakh. Tax rate is 35%, discount rate is 10%. Is the project financially viable? That means I have to find NPV. If it is positive, it is yes, financially viable. Please advise, please. Oh, wow, please, such a kind institute. They are using the polite framework. Please, wow, you are so lucky. Advise the firm on the basis of NPV of the proposal. Answer is to be based on NPV. In any case, we are going to compute NPV only. Now my question is, will we apply total approach or incremental approach or equivalent annualized benefit approach? Please reply. This question can be solved by which of the three methods? Total, incremental or EAB? Total, incremental or EAB? Which method will you follow? Or you can follow all three. The answer is only one, incremental approach, because you see the problem says operating cost will decrease by 1 lakh. Revenue will increase by 1.5 lakh. They have not given separately revenue of old and new asset. They have directly given the incremental revenue, incremental cost, and therefore, and the life is equal. Old machine has 5-year life, new machine is also having 5-year life. So the life is equal. We will use incremental approach. EAB not required. Total data is not sufficient for total approach. Data is not sufficient for total approach. Is it right? So write down the heading, write nicely. Evaluation of the proposal. Evaluation of the proposal to replace. Evaluation of the proposal to replace the old machine by the new one. Evaluation of the proposal to replace the old machine by the new one. Evaluation of the proposal to replace the old machine by the new one. Next line, write down calculation of NPV. Next line, calculation of NPV. Next line, calculation of NPV. Format, year, particular, cash flow, discounting factor at 10%, last column present value rupees in lakhs. Present value rupees in lakhs. Your answer has to be presented nicely, okay, so that it gives you a very good, it gives the examiner a very good impression about you, that the student is a good candidate. No shortcut in the exam. Year 0, let us write in year 0 what will happen. In year 0 we have cost of new machine, outflow 15. In year 0, sale value of old machine 6 lakh. What about taxation? What about taxation? Anybody, what about taxation? Should we consider tax also, or should we ignore taxation? So you write down, assume block of asset continues. What is your income tax law if the block of asset continues? Please tell me. If your block of asset continues, will you have to pay capital gain tax, or you are not required to pay capital gain tax? Yes or no? No capital gain tax. Very good. So you write in bracket, assuming block of asset continues. And if block of asset continues, no capital gain tax. It is one of the machines, written in the starting line. One of the machines. So we will assume block of asset continues, 6 lakh. Then write down year 1, CF80. Year 1 CF80 working note 1. Year 2 CF80 working note 1. Up to year 5 write down CF80 working note 1. And then in the last year write incremental salvage value. Incremental salvage value means salvage value of the new asset 9 lakh minus salvage value of the old asset. In fact, salvage value of the old asset is not given in the problem. 6 lakh is given, but that 6 lakh is today in year 0. 6 lakh is not after 5 years. You can't assume the salvage value of the old asset today is also 6 lakh and after 5 years is also 6 lakh. Such a bad assumption. If nothing is given, it is better to assume salvage value of asset will be 0 once its life is over. Okay, so 9 lakh. And what about taxation on this? What about taxation? Same assumption. Assume block of assets continues. Hence, no capital gain tax. This is taught in income tax. Profits and gains of business and profession. That if your block of asset continues, then there is no need to pay capital gain tax. 9. So what is my main task now? My main task now is to find CFAT. We'll prepare a small table, only 10 columns, only 10, not more, only 10 columns. So write down working note 1, working note 1, working note 1 write down CFAT, rupees in lakhs, CFAT rupees in lakhs. Any other format is welcome if your answer is same. First column year, second one big column savings, and under savings we have total 4 columns. There are 3 savings. Maintenance of old machine will not be required now if you replace. Second benefit is decrease in operating cost, decrease in operating cost, decrease in operating cost. Third is increase in revenue, third is increase in revenue. Fourth is total, fourth is total. Is it right? Increase in revenue and fourth is total. Then depreciation, because WDV method is there, depreciation will be 2 columns, opening WDV and depreciation at the rate 25%. Opening WDV, depreciation at the rate 25%. Then you write down PBT, then you write down PBT, then write down tax at the rate 35%, tax at the rate 35%, tax at the rate 35%, and the last column write down CFAT, the last column CFAT. There are so many columns, write down the column number also. 1, 2, 3, 4, 5. 5 will be 2 plus 3 plus 4, 6, 7. 8 will be 5 minus 7. 5 is total saving minus depreciation, 9 is tax, and 10 will be, to keep it simple, total cash inflow minus tax, 5 minus 9, 5 minus 9. Or you can write PBT minus tax plus depreciation, PBT minus tax plus depreciation. Then you have to write 8 minus 9 plus 7. So that will require more calculation. Okay, either you can write 8 minus 9 plus 7. I don't have an objection. I don't have any objection if you write 8 minus 9 plus 7. Suppose you are trained in this format only. Your mind does not accept anything other than this. Then you can write 8 minus 9 plus 7. Okay, now start. Year 1, 2, 3, 4, 5. If you continue to use the old asset, you would have incurred maintenance cost from 6th year of the installation. 3 years are over. Next 2 years, you will not incur maintenance cost. But after that, you will incur 50,000. We are writing in lakhs, 0.50. We are writing in lakhs, 0.50. Okay. Then we will write decrease in operating cost. Operating cost will decrease every year by 1 lakh. This is constant 1 lakh, and my revenue will increase, last fourth line of the question, 1.5 lakh. Question in front of you. In order to enjoy the benefit of this chapter, keep questions in front of you. Okay, only watching the show is not enough. Participating is important. Total saving, come on, total saving 1 plus 1.5, 1 plus 1.5, 2.5, 2.5, 3, 3. Stop, wait for further instruction. Now my question is, opening WDV. How much will you write opening WDV? How much will you write opening WDV? Please reply. Because if this number goes wrong, if the first number is wrong, then all depreciation will be wrong, all PBT will be wrong, all tax will be wrong. So this number has to be chosen carefully. Yes, please reply. Why do you go in silent mode? You just have to tell me one figure here. How much will you write? Okay, I'll give you option 6, 9, 15. 6, 9, 15. What is my opening WDV? There are 3 choices only, 6, 9, 15. One student has brought his own number, 421,875. I never gave that option. The answer is, oh my God, some students are saying 6, some is saying 421,875. Okay, this is not right. 6 is also not right. Only 2 choices are left now. Again try. Only 2 choices are left. 9 or 15. 9 or 15. What is your concept of block of asset? This is block of asset. Before sale of old asset and purchase of new asset. Then we purchased a new asset of 15 lakh. Suppose this block value is X and we purchased an asset of 15 lakh. So now the block value will become X plus 15. Now the block value after purchase of new asset is X plus 15, and we sold one old asset for 6 lakh. So my block will reduce by 6 lakh. This is original, this is addition of it. We sold 6 lakh. So by this amount the block will reduce. So my block will increase now by 15 plus minus 6. So net increase in the block is 9. So this block of asset will be X plus 15 minus 6, X plus 9. And this block is X. What is the increase in the block of asset value? Earlier we were getting depreciation on X amount. Now I am going to get depreciation on X plus 9 amount. We are following incremental approach. So if your block value was X earlier, after sale and purchase, your block is X plus 9. So incremental depreciation will be on 9. 9 write down. 15 minus 6. I hope you know block of asset. Suppose I'll put a dummy number, block of asset value. There are many machines. Let us say 50 lakh. Then your income tax teacher will tell you add purchase 15 lakh. I am not an income tax teacher. Less sale value. Sale value is fully deducted. I hope you know that. We don't compute the WDV of the asset sold in income tax. The entire sale value is fully deducted. So minus 6 lakh. So now my block is 59 lakh. Therefore, increase in block is 9 lakh. And we are following incremental approach. So my depreciation will also be on incremental amount. Hence 9 lakh is right. In bracket just write down 15 minus 6. By 15 block will increase, by 6 block will decrease. So in future you will get depreciation on 9 lakh rupees more. Okay, now we'll continue. 9 into 25% for 2.25. Next year opening balance 6.75 into 25%, 1.69, 5.09, 1.27, 3.78, 0.95, 2.83, 0.71. Check the answer now. Depreciation column is right. Okay, now PBT column number 5 minus 7. Please respond fast. 0.25, 0.81, 0.1, 1.73, 2.05, 2.29, 2.29. Now PBT is over tax. Now first number you type 0.35 into 0.25. First time you should type 0.35 into 0.25 and then you just have to type the number and press equal to. You will get the answer. So tax in the first year is 0.09, 0.81 press equal to, 1.73 press equal to. Now type the number, press equal to, and finally we have reached the destination. CFAT. CFAT would be column number 5, which is cash inflow, minus column number 9, which is tax outflow. So write down CFAT 2.41, 2.22, 2.39, 2.28 and 2.20. Done. Now what you do, I am going to wait for you. Transfer these numbers on your main page. This is working note. Main page was drawn before this. CFAT of year 1, 2, 3, 4, 5 and then compute the NPV. I will give you 1 minute to find out NPV. I'll wait silently. Find out NPV after transferring CFAT to the main page. After transferring CFAT to the main page, yes, anybody who wants to reply. Anybody wants to reply? Anybody who got the NPV? 30 seconds more. 30 seconds more. So this is your main page. Bring those cash flows here. Write the factors at 10%. Write the factors at 10% and then compute the NPV. You can directly write the present value in the last column if you can. You can directly write the present value in the last column if you can, and please confirm. Anybody please confirm, otherwise we'll keep waiting. The chapter is very long, very lengthy. 5.33. I have tried to cover questions on every variety, every concept. Anybody 5.33? Right, very good. So write down the decision. Decision, write down. Decision. Replace the old machine by the new one. Replace the old machine by the new one because incremental NPV is positive. Because incremental NPV is positive. Second, write down one note I will dictate. Write one note I will dictate. Write a note. We have followed, note write down, we have followed block of asset concept. We have followed block of asset concept while computing depreciation. We have followed block of asset concept while computing depreciation. The block will increase by rupees 15 lakhs. The block will increase by rupees 15 lakh and the block will decrease by rupees 6 lakh. The block will decrease by rupees 6 lakh. Therefore, increase in block value is rupees 9 lakh. Therefore, increase in block value is rupees 9 lakh. Okay. Next note, write down note number 2. Note number 2. It is assumed that no capital gain tax will arise. No capital gain tax will arise on sale of either the old machine, on sale of either the old machine or the new machine. No capital gain tax will arise either on sale of old machine or the new machine. Okay, I hope my notes were clear. If you still have a query, you are free to ask. You can ask me now. Any query? Okay, go to next important question number 65. Question number 65. Again, very important question. Lot of concepts will be covered here. Keep question in front of you. To understand capital budgeting chapter, you have to practice a lot. Every question you have to practice 2 or 3 times so that you will understand the concept. Excel Chemical Limited manufactures a special chemical. Very good. It is thinking of replacing its existing machine by a new machine which would cost rupees 25 lakhs. The company's current production is 80,000. First number important is 25 lakh, new machine cost. Current production is 80,000 and it is expected to increase to 1 lakh unit if new machine is bought. So what is your increase in production? Increase in production is equal to how much? Increase in production is equal to how much? 1 lakh minus 80,000, 20,000 unit. Very good. The selling price of the product would remain unchanged at rupees 80 per unit. Your sales will increase by 80 rupees per unit into 20,000 units. So you will have an increase in revenue by 16 lakh. Is this understandable? Revenue will increase by 16 lakh. The following is the cost of producing 1 unit of product using both the existing and the new machine. So if you manufacture using existing machine, material, wage, supervision, repair, power and fuel, depreciation, allocated corporate overhead. Depreciation is a non-cash cost and depreciation will be considered separately only for the purpose of tax shield. Depreciation will be considered for tax shield. Allocated corporate overhead is irrelevant because it is an allocated overhead. It is not an incremental overhead. So allocation means only your same expense is allocated using different formulae and therefore this is irrelevant. So really speaking, what is my cash cost per unit? What is my cash cost per unit? Can you please tell me the total of these first 5 numbers only? Cash cost per unit, depreciation is non-cash cost, allocated corporate overhead is irrelevant. Anybody who would like to contribute in the discussion or as usual remain a silent spectator. 30 plus 20.5 plus 8 plus 4.5 plus 6.2. So your current cash cost of production is 69.2 per unit. And what about this new machine? Anybody who wants to reply new machine? Let me see who will reply before me. Is it 59.2? 59.2. Under existing machine, cash cost per unit 69.2. Under new machine, cash cost per unit is 59.2. Okay, very good. So I will require 69.2 and 59.2 in calculating the cost difference. The story is not over. There is a long paragraph. It says the existing machine has an accounting book value of rupees 40,000. Write down irrelevant. Accounting book value is irrelevant. Such a waste of human time and talent by giving irrelevant information. Write down yourself irrelevant, and it is fully depreciated for tax purpose. It has a remaining life of 8 years. Old machine has 8 years life. The supplier of the new machine has offered to accept the old machine in exchange for rupees 1 lakh. Again my question is this 1 lakh relevant? Is this 1 lakh relevant? Is this 1 lakh relevant? Yes, because you are going to exchange it for 1 lakh. So you are going to give old asset and buy a new asset. New asset cost is 25 lakh. Sale value of old asset 1 lakh. So net increase 24 lakh. However, the market price of the old machine is 60,000 today. Oh my God. Whether this is relevant? Quickly reply, otherwise there is no charm in learning and no charm in teaching. I would better record and give it to you. Whether old machine selling price is relevant? The answer is no, because I am going to realize 1 lakh rupees. I am going to realize 1 lakh rupees. 1 lakh is relevant. 60,000 is not relevant. 40,000 is not relevant. And what is the salvage value of the old machine after 8 years? This time they have given salvage value of old machine after 8 years 15,000. New machine also has 8-year life. New machine also has 8-year life, and new machine salvage value is 1 lakh at the end of the economic life. So you have 1 lakh from new asset, 15,000 from old asset. So incremental salvage value will be 85,000. Assume that tax rate is 50%. Oh my God, such a high tax rate. And WDV depreciation rate is 25%. WDV depreciation rate is 25%. So WDV rate means life becomes little miserable, but can't help it. It was an old exam question in CA final. The required after tax rate of return is 20%. This is my discount rate, and it is already adjusted for taxation. So don't make any more adjustment. This is final. This is final. Required after tax return, because cash flow after tax is also after tax. So discount rate should also be post tax discount rate should the old machine be replaced. I am going to ask you same boring question. Option A, total approach. Option B, incremental approach. Option C, EAC or EAB approach. Which approach we can follow? So we will follow incremental. In this question, honestly speaking, total approach is also possible. It is possible because you are given 1 lakh rupees, the today's opportunity value of the old machine, salvage value is given, life is given, and cost is given, quantity is given to be sold. So this can be solved. This can be solved under total approach also, because you have data. But total approach means solving 2 times, one for existing machine, one for new machine. Incremental approach is better. I have to solve only once. Is it right? I have to solve only once. EAB method not required, because the life of old asset and the new asset both are 8 years. So there is no need to go to EAC or EAB method. My dear learned student, write down. First I will draw main format, followed by few working notes. Heading, write down name of the company, Excel Chemical Limited. Excel Chemical Limited. Are you there? Yes. Evaluation of the proposal. Evaluation of the proposal to replace the old machine by the new one. Evaluation of the proposal to replace the old machine by the new one. Below that write calculation of NPV. Calculation of NPV. Calculation of NPV. And then you write down 5 columns. 5 columns. First column year, second particular, third cash flow, fourth discounting factor at 20%, last column, fifth column, DCF, discounted cash flow. Year 0, cost of the new machine, year 0 cost of the new machine, how much is the cost of the new machine? 25 lakh. So write down 25 lakh. Sale value of old machine 1 lakh. Sale value of the old machine 1 lakh. 1-8 write down. 1-8 CFAT. But in bracket I have written excluding tax shield on depreciation. Excluding tax shield on depreciation. What is the purpose? Other than depreciation, my CFAT is constant, but depreciation is different, so tax shield is different. To simplify my calculations, I can keep tax shield on depreciation separate and CFAT other than depreciation separate. So if I keep depreciation separate, my CFAT is going to be a constant amount per annum. So that was my strategy. And then write down 1, 2, 3, 4, 5, 6, 7, 8. You just have to compute tax shield on depreciation. You have to compute tax shield on depreciation. You write working note 2. Working note 2. Tax shield on depreciation, working note 2. And then you write down year 8 differential salvage value. Differential salvage value 85,000. 1 lakh minus 15,000. Differential salvage value 1 lakh from the new asset, 15,000 from the old asset. So incremental salvage value will be 85,000. Incremental salvage value will be 85,000. We are solving one of the very good questions on capital budgeting, replacement of old machine by the new one. Okay, if such questions are asked in the exam, then some student may not be able to get it right. Hence practice is required. Now write down working note 1. Working note 1 write down CFAT excluding tax shield on depreciation. Excluding tax shield on depreciation. Please solve yourself and give me the answer. Since you are intelligent student, I'll give you a chance. For the time being in this working note, do not bother about depreciation. Only you have to take the difference between increase in revenue minus increase in cost. The difference is cash flow minus tax is incremental CFAT. I have given you the hint. Increase in revenue minus increase in cost is equal to cash flow before tax minus tax is CFAT. Try. 20 seconds will be allowed because I have given you the hint. 20 seconds starts now. Twenty seconds starts now. Okay, time over. You can start posting your reply. What is incremental CFAT per annum excluding tax shield on depreciation? Do not worry about depreciation. Yes, please reply. If you don't reply, then it is just a copy paste exercise. Who will reply? Anybody? those who are learning from home, just try. When you try first time a new question, then only you will learn. Otherwise it is only copying. Then why do you need faculty? Books are available, you can copy from there. Answer please. 5 seconds more. 5 seconds more. Come on. What is your answer? Suppose this question comes in the exam and there is no depreciation. Forget depreciation. Sale will increase by 20,000 unit. Cost will also change by some amount. Difference minus tax. Okay. So write down the answer. First write down additional sales. Additional sale amount will be 80 rupees per unit into 1 lakh minus 80,000, 20,000 additional unit, 20,000 into 80, 16 lakh. I hope you got this right. Then additional cost. This is the point where you go wrong. Additional cost under new machine. I am going to produce 1 lakh unit. New, write down new dash 1 lakh unit into cash cost per unit. Cash cost per unit 59.2. 59.2 I had given you this number. And under old machine I am producing 80,000 unit at a cash cost of 69.2 per unit. So my total cost is 55,36,000. So by shifting from old machine to the new machine, I am going to incur only additional cost of 3,84,000. And because of that, my cash flow will increase in PBT, 12,16,000. Tax at the rate 50%, 6,08,000. Therefore, incremental CFAT, 6,08,000. Therefore, incremental CFAT 6,08,000. Oh, this was the answer. Yes, this was the answer. Is it right? So who got it right? Anybody who got it right? Anybody who got it right, either say yes or no. Who got it right? 6,08,000 before I started. Transfer it to the main page. Transfer it to the main page. In the main page, third line, 1-8 incremental CFAT, right in front of that 6,08,000. And now one more last part of this question is, write down working note 2. Working note 2 is tax shield on depreciation. Tax shield on depreciation. Tax shield on depreciation. Under that tax shield on depreciation, draw 4 columns because WDV method is there. First column year, second column opening WDV, third column depreciation at the rate 25%, fourth column tax shield at the rate 50%. Tax shield at the rate 50%. Okay, are we there? Everybody, please tell me what is my first number here to start with. Should we write 25 lakh, 24 lakh, or 24.6 lakh, 24.4 lakh? What is my opening WDV? Please reply. Otherwise, I will just go ahead without discussion. Anybody answer for opening WD, because if that number goes wrong, all your 8-year calculation will be wrong. Okay, so think and reply. 25, 24, 24.6, 24.4. Anybody? What is your answer? 24 is the right answer. Sir, why? In bracket write down 25 minus 1. Like in previous question, our block of asset will increase by 25 and reduce by 1 and reduce by 1. So the answer will be 24. Same note you will copy. Same note you will copy. Depreciation write down 6. Depreciation 6. Tax shield 50% of this number 3. Now you can complete yourself. 24 minus 6, 18 into 25%, 4.5 into 50%, 2.25. Just little fast now. 13.5, 3.38, 1.69, 10.12, 2.53, 1.27. Complete the table till last year. On your own you can do. You don't need my help here. You are a learned student. You have reached this level of our exam. Means you can't be an ordinary candidate. Ordinary candidates don't pass the filter of foundation and inter. Those who have passed the filter of foundation and inter are not ordinary students. Now we'll transfer these numbers to the main page. Go to the main page. In the main page you have written tax shield on depreciation. Please post it there and compute the NPV. Compute the NPV on your own. Try at least. How much will you copy? NPV please. So this is how your final answer would look like. Just check and confirm that your answer is 6.03 positive NPV. Please check and confirm. Please check and confirm your positive NPV 6.03. Okay. Even if you have not got it, please write it, check it later. Otherwise we will get delayed. Write down NPV 6.03. NPV 6.03 and now write down the decision. Write down the decision. First write down decision. The company should replace. Decision. The company should replace the old machine with the new machine. The company should replace the old machine with the new machine. Okay. Now write down why. Because incremental NPV is positive. Because incremental NPV is positive. Because incremental NPV is positive. Now write down notes. Notes write down 1. It is assumed that the block of asset will continue. It is assumed that the block of asset will continue. Hence, there will be no capital gain tax. Hence, there will be no capital gain tax on the sale of old or the new machine. Hence, there will be no capital gain tax. Hence, there will be no capital gain tax on the sale of the old or the new machine. Next note write down. depreciation has been calculated on the increase in block of asset value. Depreciation has been calculated on the increase in the block of asset value. Depreciation has been calculated on the increase in the block of asset value. It is assumed that the company will purchase the new asset first and then sell the old asset. Company will purchase the new asset first and then sell the old asset So when you purchase the new asset and sell the old asset, first block will increase by 25 lakh, then you sell the old asset, block will decrease by 1 lakh, so 24 lakh. Is it right? Next note, write down, next note number 3, the existing book value of the old asset is not relevant. The existing book value of the old asset is not relevant. Third note, write down, the current market price of the old asset. The current market price of the old asset is not relevant because the company is going to exchange the old machine. Company is going to exchange the old machine for rupees 1 lakh. Company is going to exchange the old machine for rupees 1 lakh. Company is going to exchange the old machine for rupees 1 lakh. So the current market value is also not relevant. Had that exchange offer not been given, then I would have taken market price. Okay. Now my side, I have explained you all the concept, all the notes. Still, if you have doubt, you can ask me. Is it right? If you have doubt, ask me. Okay, we'll take question number 66. 66 number question has a history behind it. Again, you see, in my exam there were 3 questions on capital budgeting. This is the third question. Appeared in November 99 exam. The exam in which I appeared was full of capital budgeting questions. That does not mean that is the only reason I came in the rank. Okay, there were other questions also. So please come to question number 66. Mark it again, important, already tested for 14 marks in the exam. AS Limited has been producing a chemical product by using a machine Z. Old machine is called Z. For the last 2 years, now the management of the company is thinking to replace the machine either by X or by Y. Oh my God. So this time you have to make a choice whether you should replace Z by X or Z by Y. So more complicated question, because you have to solve it twice. One comparing Z with X, second comparing Z with Y, and the one which will give higher incremental NPV, that will be selected. Book value of old machine is 1 lakh. This book value of old machine is irrelevant. Resale value today is relevant. If I sell it today, I'll get 1,10,000. So that becomes my opportunity value of this old asset. Because if I am going to replace it, it means I'll get 1,10,000. If I continue it, the opportunity value is 1,10,000. The purchase price is given for new asset, annual fixed cost, underline the word including depreciation. In your exam, they may make it excluding, so be careful. Depreciation is already there. Only I have to adjust it while computing CFAT variable running cost including labor per unit variable running cost is given. Production per hour is given 8, 12 production per hour in unit. So I have to do some costing type calculation also. You are also provided with the following details. Selling price is 20, material 10, annual operating hour 2000. 2000 hours into production per hour will give you total production. Okay, total production, total quantity. Once you get the total quantity per annum, then you can do the remaining calculation. Working life of each of the three machine as from now 5 years. So life is equal. I don't have to apply EAC or EAB method. Salvage value of machine Z is 10,000, X 15,000, Y 18,000. So this will be required for depreciation calculation and also NPV calculation. Company charges depreciation using straight line method. Thank God. This time it is SLM. Previous two questions were WDV. That took lot of time. It is anticipated that an additional cost of rupees 8,000 per annum would be incurred on special advertisement to sell extra output of machine Y. Now this 8,000 is only applicable for machine Y because of extra output generated. You need to incur some advertisement cost. Assume that tax rate is 50%. Again, thank God, easy calculation. Cost of capital 10%, PV factor. If PV factors are given, preferably use it. Okay, using NPV method. Which method? NPV method. You, who is required? You are required, not me, to analyze the feasibility of the proposal and make recommendation. 14 mark question. This question is a mixture of costing and finance, because first few minutes to find the profit, it is like a costing problem. Operating hours, number of hours, output, variable cost, fixed cost, selling price. So let us first compute incremental CFAT. Write down step 1, calculation of incremental CFAT. Very simple. If you see first part, computing CFAT is very easy. Just think you are sitting in a costing class and these are some basic data given to you. 3 columns on the right side, machine Z, machine X, machine Y. Okay, 3 columns you have drawn. Then write down annual operating hours. Annual operating hours 2000 hours. 2000 hours. Is it right? Our article student work more than this in a year. True or false? Article student, true or false? You work more than 2000 hours in a year. You work for 365 days into, let's say, 8 hours per day. So that is 2920 hours. My God. And on tax audit season, you work 15-18 hours also. Some of you don't go back to your home only. Next point number B, production per hour. Production per hour is 8, 8, 12. Question in front of you. Total production units. So total production in units A into B, 16,000, 16,000, 24,000. Selling price per unit in rupees. Selling price per unit in rupees. This is 20, 20, 20, 20, 20. Sales. Total sales write down. Total sales C into D. Very easy. I don't have to explain. C into D, quantity into rate. 3,20,000, 3,20,000 and 4,80,000. Point number F, cost. There are four costs in this question: variable cost, material cost, fixed cost and special advertisement cost for machine Y. So first you write down material cost at the rate rupees 10 per unit. Material cost at the rate 10 per unit, multiply 10 into quantity. 10 into quantity, 1,60,000, 1,60,000, 2,40,000. Next is variable running cost. Variable running cost. Variable running cost, how do you compute it? It is given per unit. It is given per unit, 3 rupees per unit. So for machine Z, it will be 48,000, 3 into 16,000. For machine X, it is given 1.50. 1.50 into 16,000. 1.50 into 16,000 in bracket, answer 24,000. And for machine Y, it is 2.50 per unit into 24,000 unit. Answer above 60,000. Calculation in bracket below that. Later on there should not be any confusion, so we should write all calculation. Now write down annual fixed cost including depreciation. Annual fixed cost including depreciation given in the problem: 92,000, 1,08,000, 1,32,000. Special advertisement cost written below. Special advertisement cost somewhere below, it is given 8,000. 8,000. Total, F means total cost. Please take total of this four cost and write below 3 lakh, 3 lakh, then write down 2,92,000, 2,92,000, and then write down 4,40,000, 4,40,000. Now write down PBT. PBT will be E minus F. This is E sales, this is F total cost. First column 20,000, second column 28,000, third column 40,000. Then write down PAT. PAT will be PBT into 50% because tax rate is 50%. So PAT will be half of PBT. PAT will be half of PBT. 10,000, 14,000, 20,000. Then add back depreciation. Depreciation is already included here in fixed cost. But to calculate CFAT, I need to add back depreciation. And what is the method of depreciation? The method of depreciation is SLM. SLM. SLM means cost minus salvage value divided by number of years. Okay. So that is my formula for SLM. For machine Z, be careful. In machine Z, now the replacement cost or the sale value or the opportunity cost is given 1,10,000. So that number I will take minus salvage value 10,000. Minus salvage value is given in the last few lines. Salvage value 10,000 divide by remaining life 5 years. Divide by remaining life 5 years. So that is 20,000. Working note should be written. Later on you will forget. Now for machine X, 1,80,000 minus 15,000 divided by 5 years, 33,000. For machine Z, Y, for machine Y, the sequence is Z, X and Y. That is why we are getting confused. No problem. 2 lakh is the cost, 18,000 is the scrap value, number of years 5. So please check the answer. This is not 20,000. This is something different. I'll write 2 lakh minus 18,000 divided by 5, 36,400. Is it 36,400? Is it 36,400? Okay. Now we got the depreciation. Add CFAT. Add CFAT. H plus I. 10 plus 20. 30,000. 14 plus 33. 47,000. 20,000 plus 36,400. 56,400. 56,400. Now I hope all of you have noted. If I continue with machine Z, my CFAT would be 30,000. If I substitute replace by machine X, my CFAT will be 47,000. And if I buy machine Y, my CFAT will be 56,500. So write down point K, incremental CFAT. Incremental CFAT, if I replace Z by X, how much will be my incremental CFAT? 47,000 minus 30,000. I will get 17,000 more. 47 minus 30. But if I replace Z by Y, I'll get 56,400 minus 30,000 incremental CFAT. So that is 26,400. That was this wonderful calculation. It's a combo of, up to this it is like costing question, and suddenly it becomes a FM question. I am going to use this 17,000 and 26,400 in my NPV calculation. Last two numbers are only relevant for further discussion. Step number 2, write calculation of incremental NPV. Calculation of incremental NPV. Calculation of incremental NPV. I have drawn this table with total 7 columns. Year, particulars, PV factor at 10%. Then machine X, under that 2 columns, cash flow, present value. Machine Y, 2 columns, cash flow, present value. Ready? Now what we'll do, after you have drawn the format, please inform me. Yes, year 0, incremental investment will write. Incremental investment will be, in case of machine X, if I buy machine X, I'll incur 1,80,000, but then I will sell the old machine for 1,10,000. I'll sell the old machine for 1,10,000. So I have to incur additional amount of 70,000. Present value will be same. Try the next one yourself. Y will cost you 2 lakh. If you sell Z, you will get 1,10,000. So your incremental investment, if you purchase machine Y, is 90,000. Present value 90,000. Now write down 1-5 incremental CFAT. Incremental CFAT in bracket step 1. And add the factors given in the question. Please add the factors given in the question They have given you some factors, please add. Is it 3.79? Is it 3.79? Go to your step 1. 17,000 is incremental CFAT for machine X. Multiply 17,000 into 3.79, 64,430. Please check. I have not checked. I have just written like this randomly. Okay. And if you substitute by machine Y 26,400, please multiply and check. 3.79 into 26,400. Question has been asked in CA final exam November 99. The same exam in which I had appeared. Incremental salvage value. Step number 5, incremental salvage value. Year 5 incremental salvage value 0.621. Factor take from book. Factor take from book. If you replace X, if you replace machine Z by X, your incremental salvage value will be how much? 15,000 minus 10,000. Write calculation also. 15,000 minus 10,000, 5,000. Present value multiply by 0.621, 3105. And if you replace by machine Y, 18,000 minus 10,000. 18,000 minus 10,000. Question in front of you. Last 5-6 lines. 8,000 multiply by 0.621, 4968. 4968. My dear highly talented students, add these numbers and write NPV. Anybody first column total? First column total is equal to negative 2465. Oh my God. Is it negative? Second column 15024 positive. Please check this number again. One student is replying 8675. It can't be 8675. It is negative. This is not right. Please check. And this is right. 15024 is right. Now you have replied correctly. 2465. So what is your conclusion? The conclusion is company should replace machine Z with machine Y because incremental NPV is higher. Because incremental NPV is higher. Question was using NPV method. Using NPV method. So this is my NPV method. This is my NPV method. Okay. So this is the answer of this question. Now we'll take a break. During break, you can either try question number 67 or you can rest, relax, enjoy tea, coffee, biscuit, idli, dosa, sambar, chutney, uttappa. Okay, welcome back. Let us read question number 67. All of you please read question number 67. A company named Robbie's Cube, wow, decided to replace the existing computer system of their organization. The original cost of the old system was rupees 25,000 and it was installed 5 years ago. The current market value of the old system is rupees 5,000. Tick mark. This is the amount you will get if you sell it today, and it was purchased long back for 25,000 and 5 years are already over. Depreciation of the old system was charged with the life of 10 years with estimated salvage value as nil. So old asset they were depreciating at the rate 2,500 per annum. 5 years are over. So 12,500 has already been depreciated. 12,500 has already been depreciated. Depreciation of the new system will be charged with life over 5 years. New system has again remaining life of 5 years. Present cost of the new system is 50,000. This is my year 0 investment in new system. Salvage value of the new system is 1,000. So for depreciation purpose, I will take 49,000 divided by 5. For depreciation purpose, we will take 49,000 divided by 5. And the next is estimated cost saving from the new system is 5,000. This is one advantage of the new system. You will get 5,000 rupees cost saving plus increase in sale with the new system is assumed at 10% per year based on original total sale of 1 lakh. Sale will increase by 10%. So increase in sales will be 10,000. Increase in sale will be 10,000. Cost saving will be 15,000. You will get some depreciation benefit also. You will get some additional depreciation benefit also. Company follows straight line method of depreciation. Cost of capital of the company is 10%. Tax rate is 30%. Tax rate is 30%. Is it right? And you write one note here. Assume sale of computer system will be subject to tax. Assume sale of computer system will be subject to tax, because when I refer the institute answer, they have assumed that when you will sell the old system, there will be tax implication. If we assume block of asset concept, then there won't be tax implication. So answer can differ. So we will assume that if we replace the old machine by the new machine, the old machine will be sold and it will have tax implications. So write down step 1, amount realized on sale of old system, amount realized on sale of old system net of tax. Step number 1, if you change the assumption, the answer can change slightly. Amount realized on sale of old system net of tax. Amount realized on sale of old system net of tax. First point A, write down sale value. Sale value is given 5,000. Please everybody participate. What is the book value on the date of sale? It was purchased for 25,000 5 years ago. Total life is 10 years. 25,000 minus 25,000 divided by 10 into 5. Total depreciation already charged 12,500. So the date on which it was sold, the book value is 12,500. So there is a loss. Oh my God. Sale value is less, book value is more. How much is the loss? Yes, anybody? Simple question. How much is the loss? A minus B. Loss is equal to, very good, 7,500. But then loss also has a silver lining. Loss also has an advantage. It will be helpful in tax saving. Loss also has tax saving. Loss can be adjusted against some other income and you will have tax saving. So tax saving will be 30% of 7,500. Please calculate 30% tax saving. Assume that loss will be adjusted against other income. So 7,500 into 30%, 2,250 will be tax saving. Tax saving is 2,250. 5,000 is sale value. Now I am going to ask you a basic fundamental question. What will be net amount realized? What will be net amount realized? Please reply. If you are claiming you are a final student, what is net amount realized? What is net amount realized? Net amount realized would be, you are not willing to reply only. I am so sad. 5,000 rupees sale value. If you think like an accountant, bank account debit to asset account, 5,000 inflow. Tax saving is also inflow. Tax saved is cash inflow. Therefore, your answer is sale proceed plus tax saving A plus D, 7,250. 7,250. Some student replied earlier 7,500. Then they replied 2,750. OMG. Oh my God. Sale value, if you want to write for future reference, is cash inflow. Tax saved is cash inflow. So total cash inflow will be 7,250. Step number 2, write down incremental CFAT right hand side rupees. Right hand side rupees, question in front of you. Question notes should be continuously in front of you to enjoy the benefit of this chapter. Increase in sale 10% of 1 lakh, 10,000. Cost saving 5,000. Cost saving 5,000 given in the problem. And we have to compute incremental depreciation. Incremental depreciation means if I would have continued with the old machine, how much depreciation I would have got? If I purchase the new machine, how much depreciation I will get? The difference between depreciation I will get from new machine minus depreciation I would have got from the old machine is called incremental depreciation. So please write down first point, incremental depreciation 1, new system. Under new system 50,000 minus 1,000 divided by 5, that is 9,800 you are getting. If you purchase new asset, you will get 9800 depreciation. Under old system, we were getting a depreciation of 25,000 minus 0 upon 10 year, that is 2,500. 9800 minus 2500, 9800 minus 2500 is your incremental depreciation. 7300. Sales will increase profit. Cost saving will increase profit. Depreciation will decrease profit. Therefore, incremental PBT. Anybody incremental PBT A plus B minus C, your taxable income will increase by 7700. Very good. And incremental PAT, tax rate is 30%. So 70% will be PAT. Take 70% of 7700. Very good. How much is incremental PAT? 5390. And if you want incremental CFAT, you will add PAT plus depreciation. Write down incremental CFAT E plus C. Anybody? 5390 plus 7300, 12690. Therefore, we will take 12690 as incremental CFAT from the new system. Now we are ready to compute incremental NPV. Write down step 3. Write nicely, draw table, use calculator, use pen, pencil, scale. Incremental NPV, right hand side, total 5 columns, year, particulars, cash flow, PV factor. What is the PV factor? Is it 10%? PV factor is 10%. Okay. And present value. Very easy. All working notes are ready. Year 0, cost of the new system 50,000. Year 0, cost of the new system 50,000. Year 0, sale of old system, bracket step 1. Sale of old system including tax adjustment, step 1. 7250. Then write down 1-5 incremental CFAT. Step 2, 12690. Please write down the factor for 10% and 5 years. 3.79. That we got in the previous question also. So I took it from there. 48095. Incremental salvage value from the new system you will get 1000. Old system has 0 scrap value after 5 years. So incremental is 1000. Calculation in bracket 1000 minus 0. Everything should be written. Nothing should be written directly. This is professional exam. They want some professional competence from you. Anybody who wants to reply the last column total NPV. Let us see who will answer first. Last column NPV. Anybody quickly. Last column NPV. Waiting for your answer. One student has replied. Very good. 5966. Is it 5966 or 5966 is right. 5966 is right. So write the decision. Replace the old machine with the new machine. replace the old machine with the new machine as the incremental NPV is positive, and write one assumption which actually I have dictated in the question. If this same question comes in the exam and you want to solve it in this manner, then you will write this assumption: sale of old machine will be subject to tax. Sale of old machine will be subject to tax. Sale of old machine will be subject to tax. Okay, one more question we'll solve. Question number 68. This is from your study material. 68 number. A company has an old machine having book value 0, which can be sold for rupees 50,000. The company is thinking to choose one from the following two alternative. Okay, so old machine book value is 0 and sale value is 50,000. Sale value is 50,000. The company is thinking of two alternatives now. What are the two alternatives? One is to incur additional cost of 10 lakh to upgrade the old existing machine only. That is, don't sell it, upgrade it. Upgrade it, and the investment required in upgradation will be 10 lakh. To replace the old machine with a new machine. Second is replacement. The replacement machine will cost you 20 lakh plus installation cost of 50,000 also. 20 lakh 50,000. Both the above proposals envisage useful life to be 5 years with nil salvage value. Salvage value under upgradation or under replacement will be nil. The expected underline after tax profit. After tax profit means PAT is given. It is not CFAT. You have to compute CFAT by adding back depreciation. You have to compute CFAT by adding back depreciation. Please focus now. If you continue with the old machine, these are your PAT. An old machine already has 0 book value, so depreciation will be 0. Depreciation will be 0. If depreciation is 0, then PAT will become equal to CFAT. PAT will become equal to CFAT if depreciation is 0, because old machine already has reached 0 book value. So depreciation has already been fully claimed. So I will assume no more depreciation. PAT is equal to CFAT. However, in the other two options, you will have to add depreciation to arrive at CFAT. Add depreciation to arrive at CFAT. Next is tax rate is 40%. Company follows straight line method of depreciation. Very good. Cost of capital is 15%, discount rate. And these are the factors. You will use the same factor. You will use the same factor, and then you are required to advise which alternative is to be adopted. Okay. So I will solve it twice. One, replace. First option I will write upgrade the existing machine, and second option replace the old machine. If I try this option, I will have to compare these two. If I continue with old machine, if I upgrade to new machine, what will be my incremental CFAT and take NPV? If I replace old by new, I'll compare these two, compute incremental CFAT and get the incremental NPV. Whichever gives me higher incremental NPV, that option we are going to exercise. Is it right? So write down alternative 1, upgrade the existing machine. Upgrade the existing machine and directly will compute NPV in this table. Directly will compute NPV. Please write down little fast. Calculation of NPV. Calculation of NPV. In one table we will solve, because in the exam we have limited time. So we'll have to find out ways to cut short the time required to solve the problem. You will say answer is given, but the answer is presented in a very lengthy format. I am going to show you how you can save time. Year, then write down upgraded machine, 3 columns. Under upgraded machine you write down 3 columns: earning after tax, or you can write PAT, profit after tax, depreciation, CFAT. Depreciation will be added back. Earning after tax means all expense, depreciation, tax have been deducted. So I just need to add depreciation. Earning after tax means all cash, non-cash expenses have been deducted. Tax have been deducted. Compare it with the CFAT of the old machine. In case of old machine, because its book value is 0, no more depreciation will be claimed on that, and therefore its earning after tax and CFAT will be same, because depreciation is not there. Difference between these two columns is incremental CFAT multiplied by PV factor given in the problem, and you will directly get the PV. PV factor multiply, you will get PV. Start year 0, 1, 2, 3, 4, 5. Year 0 I will write at the end only, investment, not now. Year 0 I will use later. Then copy the earning after tax of upgraded machine, middle column, from the question book. This is given in the upgraded machine column. How much depreciation will you charge? How much depreciation you will charge? How much depreciation you will charge on upgraded machine? Cost is 10 lakh. Life is 5 year. How much depreciation you will claim now? 10 lakh divided by 5, 2 lakh. 10 lakh divided by 5, 2 lakh. Again copy 2 lakh. Only first line do the calculation. Later on you will forget how this 2 lakh has come. 10 lakh is the cost of upgradation. CFAT will be earning after tax plus depreciation. So learned student, please add these two columns. 7,50,000, 7,90,000, 8,10,000, 8,50,000 and 9 lakh. Okay. CFAT of old machine, in the question old existing machine column, earning after tax is CFAT for old machine. Same figures please copy. Copy the same figures. Now compute the difference. Compare this column, these columns, and write the incremental CFAT. In year 0 you write 10 lakh also as an investment. In year 0 write down 10 lakh as investment. Okay. Anybody? First year incremental CFAT 2,50,000. Second year 2,50,000. Very good. Third year 2,30,000. Very good. Fourth year 2,30,000. Come on, next. Last 2,40,000. Now it becomes like a simple question of capital budgeting. This is my cash flow. Factors are given in the question book. multiply by factors given in the problem. 2,50,000 into 0.870, 2,17,500. 2,50,000 into 0.756, 1,89,000. 2,30,000 into 0.658, 1,51,340. 2,30,000 into 0.572, 131,560. I hope you are using memory plus function also. And the last one, 2,40,000 into 0.497 equal to 1,19,280. First you add these numbers, minus 10 lakh, answer NPV. I will wait for your answer. What is your NPV? Please reply. It can be positive, it can be negative. Total of the last column. Please check 191 something. That's right. 1,91,000 something is right. 1,91,320 or 520. Okay, you are right. Negative. Last, now write down alternative 2. Alternative 2. Instead of upgrading the old machine, you can replace it by a new machine. Very good question. This is how we also think. Should we upgrade or should we buy a new one? Step 1. Cash outflow in year 0. Step 1. Cash outflow in year 0. First, let us write down what will be my initial investment in year 0. I will purchase new machine 20 lakh. New machine 20 lakh. Anything else? Yes. Installation cost is also there, 50,000. So just draw one line here. Draw one line here. Total cost of the new machine. Total cost of the new machine is 20,50,000. Even installation cost will be capitalized. Less disposal proceeds of old machine net of tax. Less disposal proceeds of old machine net of tax. Old machine has a 0 book value. You will sell it for 50,000. Entire 50,000 is your capital gain minus 40%. Minus 40%. So what you will get in your pocket is 30,000. 30,000. So my net cash outflow will be 20,20,000. Net cash outflow will be 20,20,000 because I'll get 30,000 rupees by selling the old machine. If your question is why we have not taken this in the upgradation, in upgradation we are not selling the machine. We are continuing with the same machine. We are only upgrading by adding new components, new software. Okay. But when you replace it, you will sell the old one. Next point, depreciation on old machine. Depreciation on new machine. On new machine, you will get depreciation on total cost of the new machine, including installation cost. So my cost of the machine is 20 lakh, installation cost is 50,000. Total amount on which depreciation will be claimed is 20,50,000. Okay, divide by 5 years. 4,10,000. 4,10,000. 4,10,000. Then the student can ask me a question, why we have not taken 20,20,000? The reply to that question is, sale of old machine is not considered. Sale of old machine is not considered because it is assumed that the asset belongs to different block. because it is assumed that the asset belongs to different block. It is assumed that the asset belongs to different block. Now write down step 3, same format, calculation of NPV. Same answer now, calculation of NPV. Write down format year, new machine, under new machine 3 columns, earning after tax, which is given in the problem. Earning after tax is after tax, depreciation, etc. Depreciation we have computed. Depreciation we have computed in step 2. Earning after tax plus depreciation. Earning after tax plus depreciation will give you CFAT. Will give you CFAT. Then compare with the CFAT of the old machine. Compare with the CFAT of the old machine. Difference is incremental CFAT. Last column PV at the rate 15%. PV at the rate 15%. Same to same format so that you will understand. Year 0 write down, but that figure I will write in the last 2 columns only. Look at your question. Earning after tax of new machine 6 lakh. 6,40,000, last column 6,90,000, 7,40,000, 8 lakh. Just write down along with me. Depreciation working note I have prepared. So please go there and copy. You will find 4,10,000 there. 4,10,000. 4,10,000. Add depreciation. Add depreciation. You will get 10,10,000. 10,50,000. 11 lakh. 11,50,000. And what is the last answer? 12,10,000 is right. 12,10,000. CFAT of the old machine copy from the question book first column. That does not require depreciation add back because the book value of the old machine is 0. Now my job is done. You will find first incremental CFAT. Difference between CFAT of new machine and CFAT of old machine. In year 0 also write down outflow 20,20,000. Year 0 outflow. Then incremental CFAT 5,10,000, 5,10,000, 5,20,000, 5,30,000, 5,50,000. Check the calculation. If it is right, please inform me. If it is right, please inform me. Now the next point is present value calculation. Very important question, likely for exam. Don't miss it. 20,20,000. Multiply by the factors in the problem and all of you will get same answer. 443,700. Multiply by second year factor in the problem. 385,560. 342,160. 3,03,160. 2,73,350. Please check the total. What is NPV now? Anybody for NPV? Anybody for NPV? NPV please. Total of the last column. NPV please. You are getting negative 2,72,070. Interesting. Both are negative. The previous answer was also negative. This is also negative. So what do I do? What do I do? Should I upgrade? Your answer is 272, 505. That is also okay. Wonderful. Don't worry. Now my question is, what should I do? Continue with the old machine, or upgrade to the new machine, or purchase a new machine? Please tell me. I will do accordingly. So the answer is continue with the old machine. Very interesting answer. Both the options have negative NPV. So it is better to continue with the old machine. Write down decision, as both alternatives have negative NPV. As both alternatives have negative NPV, continue with existing machine. Continue with the existing machine only. Continue with the existing machine. Okay. And write one assumption. As per the institute answer, I have made this assumption. If assumptions can change, answer can change. Sale of old machine will be subject to tax. Sale of old machine will be subject to tax. Sale of old machine will be subject to tax. Okay. Now you will find that in some question we are assuming block of asset, in some question we are taking tax on sale. That's a little confusing, because if you analyze institute question of last 30-35 years, which I have done, they are very inconsistent on this particular area. Whatever you do, you'll have to write the assumption. Okay. So one homework I will give you. Question number 70 homework. Question number 70 homework. Easy question, and the answer is also well drafted in the study material for a change. So you can solve in the notebook. Don't read the answer, will not help you. When you solve yourself, your mind will be fully absorbed in understanding and applying your thoughts. So please close the answer, solve it, check the answer, and see to what extent you have got it right and where you have gone wrong. That will be more useful for your preparation rather than just reading the SFM answer. It is like reading a swimming book. Without actually swimming, you are not going to learn swimming. Similarly, you are not going to learn financial management unless you solve in the notebook yourself. Do not give me excuse that you don't have time. If you have time to eat, you have time to do homework also. Okay. So thank you. See you tomorrow. Bye bye. Take care. For CA final student, what do you need? You need a very comprehensive material. You need a very experienced teacher. You need that the concept should be explained to you with detailed analysis and complete clarity. You should feel confident when you prepare for your exam. So we at AS Foundation have prepared very comprehensive material, very comprehensive video lecture, and to benefit the maximum number of students, we have come out with a scheme where you have to pay only for the books, admin cost, courier charges, and you will get the entire new course video lecture fully free. So what more do you want? You can go to our website and you can take video lecture free, pay for the books, available for FR and AFM both. And my objective is that maximum of you should benefit, and if you are watching this video, please share it with your friends also. They will understand the difference between a new teacher, inexperienced teacher, and the experience. In some profession, experience matters a lot, like whether it is medical or teaching profession, and therefore please get the maximum benefit which is available to you. Thank you very much and see you tomorrow. Bye bye.